Welcome to Finance and Wealth Matrix. 20 plus years in wealth management. Everything on this channel is about maximizing your money. Big question. How do ordinary people actually become millionaires? 4 myths. People believe lucky stock pick, crypto timing, inheritance, insider secrets. The real truth. Consistent investing plus patience plus discipline. No hype, no gambling, no overnight schemes. Today, 7 rules. Millionaires use plus a simple formula you can start today. This is not get rich quick. It's get rich for sure if you stick with it. Rule number 1. Get out of debt first. Why debt is the biggest wealth killer. Every dollar going to credit card interest equals a dollar not working for your future. Debt doesn't just cost money. It steals your momentum. 18% credit card interest equals investing in reverse, compounding against you. Millionaire mindset. Wealth is built by owning assets, not making payments. Not all debt is equal. Bad debt, credit cards, personal loans, unnecessary car payments. These have high interest rates, buy depreciating things, give no return. Example, $10,000 credit card at 18% equals $1,800 per year going nowhere. Good debt, briefly. Mortgage on appreciating property, business loan, generating income. Focus. Eliminate bad debt aggressively. First, the practical payoff plan. List every debt, balance, interest rate, minimum payment. 2 strategies. Avalanche, highest interest first, saves most money. Versus snowball, smallest balance first, builds momentum. Either works. Pick the one you'll actually stick to. Every dollar freed from debt equals a dollar you can redirect to investing. Real example, clearing $500 per month in debt payments, redirected to investing, massive long-term difference. The mindset shift. Stop seeing debt payoff as sacrifice. See it as the first investment you make. You're getting a guaranteed 18% return every time you pay off a credit card. No investment beats that guaranteed return. Rule number 2. Start investing early. Why time is your most powerful asset. Not talent, not strategy, not income. Time. Compound growth is the closest thing to a wealth superpower that exists. Einstein reportedly called compound interest the 8th wonder of the world. The numbers that change everything. Person. A starts at 25, invests $300 per month, stops at 35, 10 years only, lets it grow to 65. Person B starts at 35, invests $300 per month all the way to 65, 30 years. Person A ends up with more money, despite investing for less time. Why? Because the first 10 years of compounding are the most powerful. What early investing actually looks like. You don't need a lot. You need to start $100 per month at 25 versus $100 per month at 45. The difference over 40 years is staggering. The cost of waiting 1 year in your 20s equals tens of thousands of dollars in your 60s. Waiting for the perfect moment is the most expensive mistake you can make. The emotional barrier. Most people feel they don't earn enough to invest yet. Reality. You start with what you have and increase as income grows. The habit of investing matters more than the amount in early years. Getting comfortable with investing early equals no fear later when amounts are bigger. Rule number 3. Invest consistently, 9 to 12:30. Why consistency beats everything else. 74% of retirement success equals savings rate, how much you put in consistently. Not the funds you pick, not your timing, not your fees. Consistency. The problem with trying to time the market. Everyone wants to buy at the bottom and sell at the top. Nobody can do it reliably. Not fund managers, not experts, not algorithms. People who try miss the 10 best market days, which wipes out most of their returns. Study. Missing just the 10 best days. Over 30 years cuts your returns nearly in half. Dollar cost averaging, the millionaire's boring secret. Invest the same amount every month regardless of market conditions. Market up. You buy fewer shares, but your existing shares are worth more. Market down. You buy more shares, automatically getting a discount. Over time, this averages out your cost and removes emotion entirely. Example: $500 per month invested through 2008 crash, massive gains by 2012. How to automate consistency. Set up automatic transfers on payday before you see the money. 401k payroll deduction. Does this automatically? Use it. What you never see, you never miss. Automation removes willpower from the equation, which is exactly the point. Treat investing like a bill you pay yourself first. The emotional management piece. Scary news headline equals worst time to make investment decisions. Market drops 10% leads to instinct. Says sell leads to correct move is often buy more or do nothing. Consistent investors who stayed in through 2008, 2020 crashes saw massive recoveries. The investor who panics out destroys years of compounding in one emotional decision. Rule number 4. Diversify your investments. What diversification actually means? Not putting all eggs in one basket, but more specific than that. Spreading across company sizes, sectors, geographies, asset types. Goal: if one area collapses, the rest of your portfolio keeps working. The 4 categories of stock mutual funds. Large cap/growth and income. Big stable companies, Apple, Johnson & Johnson. Slow and steady. Mid cap/growth. Medium-sized growing companies, middle ground risk/reward. Small cap/aggressive growth. Smaller companies, higher risk, higher potential. International. Overseas companies, exposure outside the U.S. economy. Beyond stocks. Real estate, direct ownership or REITs. Bonds, stability, lower return, cushion during crashes. I-bonds and TIPS, inflation protection. The right mix depends on your age and timeline. Younger equals more aggressive, older equals more stable. The rebalancing habit. Once a year, check if your allocations have drifted. Example: stocks had a great year, now 80% of portfolio instead of 70%. Trim back, rebalance. Rebalancing forces you to sell high and buy low automatically. What diversification is not? Owning 10 tech stocks is not diversification. Owning 5 S&P 500 index funds is not diversification. They hold the same stocks. True diversification equals different types of assets responding differently to the same economic conditions. Rule number 5. Don't chase hot trends. The pattern that destroys wealth. Investment gets hyped, leads to price rises, leads to everyone piles in at the top. Prices drop, leads to fear, spreads, leads to everyone panic, sells at the bottom. Result: buy high, sell low, the exact opposite of wealth building. This has happened with .com stocks, real estate 2007, crypto 2021, meme stocks. Why smart people fall for it. Social proof: everyone else is making money. FOMO: fear of missing out on life-changing gains. Recency bias assumes recent performance continues forever. All 3 are emotional responses, not financial thinking. What millionaires do instead. Stay boring, stay consistent, stay invested. They don't need excitement from their portfolio. They get excitement from watching their net worth grow year after year. Chasing trends turns investing into entertainment. And entertainment is expensive. The next big thing trap. For every person who got rich on early Bitcoin, thousands lost money buying at the top. You only hear the winner stories? Survivorship bias. The golfing buddy with the hot stock tip equals the fisherman with the one that got away. Never invest money you can't afford to lose into anything you don't fully understand. The rule of thumb: if it's on the news, it's probably too late. If your barber is talking about it, it's definitely too late. Real wealth is built on the unsexy middle, consistent, diversified, long-term investing conditions. Rule number 6. Understand what you invest in the golden rule of investing. Never put money into something you cannot explain in 2 sentences. Not because you need to be an expert, because confusion leads to panic. When markets drop, people who don't understand what they own sell first. People who understand hold. And that's where wealth is made. What you need to know before investing in anything. What is it? What does this company, fund, asset actually do? How does it make money? What drives its returns? What are the risks? What would cause it to lose value? Why does it belong in your portfolio at this stage of life? Choosing the right advisor. Find someone with the heart of a teacher, not a salesperson. They should explain everything until you understand. Then let you decide. Red flag. Advisor who rushes you, uses jargon without explaining, or pressures you. Green flag. Advisor who slows down, uses examples, checks your understanding. You should never feel dumb walking out of a financial meeting. The fee question. What actually matters? Fees matter, but returns matter more. A fund with 1% higher fees and 4% better returns. You win with the higher fee fund. Expense ratio is the true comparison tool. Check it in every fund's prospectus. Don't step over $5 bills trying to pick up pennies on fees. Knowledge builds confidence. When you understand what you own, scary headlines don't shake you. You know your companies are still making money even when share prices drop. Understanding equals staying power, equals compounding. Working its magic undisturbed. Rule number 7. Live below your means. The biggest wealth myth. Looking rich and being rich are almost always opposites. The flashy car, designer clothes, luxury vacations on Instagram equals often financial stress underneath. Real millionaires are frequently the most understated people in the room. Used Camry, reasonable clothes, modest home, and a $3 million investment portfolio. Why the wealth gap keeps widening? Middle class. Earn money. Upgrade lifestyle to nothing left to invest. Wealthy. Earn more money to invest. Most of it to lifestyle. Upgrades are small percent. It's not about income level. It's about the gap between what you earn and what you spend. The 70% rule for raises. Every time income goes up, 70% of the increase goes straight to investments. 30% for lifestyle upgrade. You still feel the raise. But most of the new money goes to work before you get used to spending it. Lifestyle inflation is the silent wealth killer. Fight it deliberately. What living below your means actually looks like. It's not about being cheap or deprived. It's about being intentional, knowing exactly where every dollar goes. Audit subscriptions, recurring costs, impulse spending once a quarter. The question isn't, can I afford this? It's, does this move me toward or away from my goals? The mindset of everyday millionaires. They stopped caring what other people think. They live for their own family and future, not to impress others. That one shift changes every financial decision you make. They buy things because they want them, not because of what they signal to others.
The formula, plus final thoughts. The complete formula, simple as it gets one. Get out of bad debt, first 2. Start investing as early as possible, 3. Invest consistently, same amount, every month, automated, 4. Diversify across company sizes, sectors, geographies. 5. Ignore hype, trends, and hot tips. 6. Understand everything you put your money into. 7. Live below your means, always. The truth about building wealth. It's not complicated. It's just not exciting. Small, consistent investments over many years create extraordinary results. The best way to get rich quickly is to get rich slowly. Nobody in the millionaire interviews ever said, "I timed the market perfectly." They all said some version of the same thing. I started. I stayed consistent. I didn't stop your challenge starting today. Pick one rule from this video and implement it this week. Not all 7, just one. Move excess cash to a high-yield account. Set up auto invest. Pay off one debt. One move. This week. That's how it starts. Close words. Subscribe for weekly practical finance and wealth-building content. Like the video if this gave you something concrete to act on. Drop in the comments, which rule are you starting with? Next video, the exact accounts and investment types to use for each of these 7 rules.